Jason opened a new brokerage account on his phone while waiting in line at the pharmacy, something he'd meant to do for over a year but kept putting off, convinced there was some perfect moment he was supposed to wait for. There wasn't a perfect moment. There was just a Tuesday afternoon, a 5-minute form, and a decision he'd been overthinking for far longer than it deserved. The account took less time to open than the line took to move. This is what nobody explains about starting. The hardest part was never the investing itself. My name is Emory, and if you've ever felt like getting started with investing moves at the speed of continental drift, slow, confusing, buried under conflicting advice from 100 different sources, then this video should help simplify exactly what actually matters. And if that's useful to you, sticking around and subscribing helps this channel keep breaking down the parts of personal finance that usually get overcomplicated. Most people think starting to invest requires picking the right stock, timing the market correctly, or having a large sum of money to begin with. They're completely wrong, and the reason matters, because the single biggest factor in long-term investing outcomes has never been stock selection or timing. It's time in the market itself, which means the actual starting mechanism is almost embarrassingly simple compared to how complicated it's usually made to sound. What follows isn't a list of clever tricks, it's the 5 decisions that actually carry weight, in the order they'd need to happen. The first move wouldn't be picking individual companies at all. It would be opening a low-cost, broad-market index fund, the kind that simply tracks hundreds of companies at once rather than betting on any single one. This matters because index funds solve the single hardest problem new investors face, which is not knowing which company will perform well, by removing the need to guess entirely. Historically, broad market indexes have returned somewhere around 7 to 10% annually before inflation over multi-decade periods, not because any single company carried that growth, but because the average of hundreds of businesses tends to move upward over long stretches of time, even through individual companies rising and falling along the way. The second move, and one that's easy to overlook entirely, would be deciding which account actually holds that index fund before deciding anything else. A tax-advantaged retirement account, the kind offered through an employer or opened independently, changes the math meaningfully over decades, because money growing inside these accounts is either taxed once going in or once coming out, rather than every single year along the way. The difference sounds small in year 1, and becomes substantial by year 20, simply because taxes deferred or avoided are themselves compounding right alongside the investment. This isn't about chasing a loophole, it's about not leaving a structural advantage unused for no reason. The third move would be setting up automatic, recurring contributions rather than manually deciding each month whether to invest. This connects directly to a pattern behavioral economists have documented extensively. When a decision requires active willpower every single time, consistency drops sharply over months and years. But when the decision is made once and then automated, consistency holds far more reliably. Automating a contribution of even a modest amount, say $200 a month, removes the need to feel motivated every payday, which turns out to matter more than the exact dollar amount contributed, especially in the earliest years when the habit itself is more valuable than the balance. Someone might reasonably ask why not simply wait until there's more money saved up, a bigger lump sum to start with, rather than beginning small. It's a fair instinct, and there's a kernel of truth in it. A larger starting amount does compound into a larger number over time, all else being equal. Waiting has a real, measurable cost that's easy to underestimate, because every year spent waiting for the right amount is a year of compounding that can never be recovered. And starting with $200 a month at 25 produces a meaningfully different outcome by retirement than starting with the same amount at 35, not because of a different strategy, but simply because of 10 additional years for the same mechanism to work. Run the numbers and the gap isn't small either. That 10-year head start alone, at a typical long-term return, often accounts for more of the final balance than doubling the monthly contribution later would. The fourth move, and one that gets skipped constantly in favor of chasing higher returns, would be building a cash emergency fund before increasing investment contributions further. This isn't about being overly cautious, it's about protecting the investment strategy itself from an unavoidable structural risk. Because someone without emergency cash who hits a job loss or unexpected expense is often forced to sell investments at exactly the worst possible moment, locking in a loss that patient investors never had to take. A cash cushion of 3 to 6 months of expenses, sitting separately from any investment account, isn't a competing priority to investing. It's what allows the investing to actually keep working uninterrupted. Here's where this gets genuinely interesting. Once the index fund is automated, placed inside the right account, and protected by cash on hand, The fifth move would be almost deliberately boring, doing nothing else for a very long stretch of time. This sounds anticlimactic, but it's directly supported by the mechanism itself, because index funds work specifically because they don't require ongoing decisions, and every additional decision, moving money around, chasing a hot sector, reacting to short-term news, introduces a chance of underperforming the simple, automated version of the same strategy. Data on individual investor behavior consistently shows that investors who trade more frequently tend to underperform those who simply hold steady, not because frequent traders are less intelligent, but because more decisions create more opportunities for emotion to override strategy. Someone might reasonably ask about individual stocks or newer assets that get talked about constantly online, and whether skipping them entirely means missing out on faster growth. It's a fair question, and the honest answer isn't that these things never work out. Some individual stocks and newer assets have produced extraordinary returns for early holders. But the same category has also produced far more losses that simply get talked about less. And without the ability to know in advance which outcome applies to which asset, betting a meaningful portion of a portfolio on any single one turns investing into speculation rather than the structural, time-based process being described here. That doesn't mean these things are forbidden. It means they belong, if at all, in a small percentage of a portfolio that someone could genuinely afford to lose without changing their retirement timeline. By the time this same approach reaches its later years, say 10 years in, the picture starts to look different in a way worth walking through directly. 10 years of $200 a month, invested consistently, produces roughly $24,000 in direct contributions. But a typical long-term return adds closer to $12,000 in growth on top of that, meaning growth alone has added roughly half of what was contributed, without a single additional dollar of effort. A year 20, contributions sit around $48,000, while growth has compounded to somewhere near $70,000, meaning growth has now outpaced the total amount ever contributed, a threshold that quietly marks the exact point where the account stops behaving like a savings container and starts behaving like an independent, second source of accumulation. Someone might reasonably ask what happens to this plan during a market downturn, since starting in 2026 doesn't guarantee smooth conditions ahead. It's a fair concern, and the honest part of the answer is that a downturn would genuinely reduce the value of whatever's already invested. That decline is real and shouldn't be minimized. Automated contributions continuing through a downturn would be buying into the market at lower prices, meaning the very conditions that feel worst in the moment are quietly working in favor of anyone who keeps contributing rather than stopping. And historically, the investors who kept contributing through downturns have outperformed those who paused or sold over long enough time horizons. This isn't a claim that downturns are secretly good news. Existing money still loses value temporarily. It's a narrower claim that new contributions specifically benefit from lower prices, and both things are true at once. There's one more piece worth addressing honestly, because it comes up in nearly every version of this conversation: rebalancing. As a portfolio grows over years and decades, the original mix of assets drifts on its own, simply because different holdings grow at different rates, and periodically returning that mix back toward its original target, typically once a year rather than constantly, keeps the overall risk level roughly where it was intended to be. This isn't a complicated task requiring constant attention. It's a once-a-year check-in, and it's precisely the kind of maintenance that fits inside an otherwise hands-off strategy without contradicting the do-nothing-else principle described earlier. By the time this same strategy reaches its 30th year, assuming nothing more dramatic than the 5 moves already described, contributions of $200 a month total roughly $72,000, while a typical long-term return brings the account to well over $200,000, meaning growth alone accounts for nearly 2/3 of the final balance. This is the part that's easy to read past quickly, but worth sitting with directly. The majority of the final number in this scenario was never actually contributed by hand at all. It was produced by time acting on money that was simply left alone to do what it does. The math doesn't reward complexity, and it doesn't punish simplicity either. It simply rewards time, consistency, and the willingness to start on an ordinary Tuesday rather than waiting for a moment that was never actually going to arrive.